one. So this interpretation note is interpretation note 142, right? And it deals with this interest or this issue of what constitutes similar finance charges for Section 24J, right? Now, what is the context of this? Remember that if we think about similar fine, why is that defined? What in 24J makes that relevant? 24J regulates the deduction of interest, right? And the timing of that deduction. If something is similar finance charges, so in other words, not interest, but similar finance charges, then the deduction and the inclusion of income for that matter is also regulated by 24J. And so the question is, okay, fine, what is similar finance charges? And that's what this note is about, right? Now, just by way of background, in January last year, the tax court in Cape Town had to determine whether a raising fee that a bank charged or whoever charged, whether that constitutes similar finance charges for the purpose of Section 24J, right? Why is that important? You have to ask the question, why do we care about whether a raising fee is similar finance charges? I'll tell you why. Because generally speaking, a raising fee is a fee paid to acquire funds, right? If it doesn't fall into 24J, it certainly is an expense, right? Would that expense be deductible? Mostly no, because it's a capital expense. It's an expense incurred to acquire capital, right? So therefore, it would generally not rank as a deduction. So if we fall outside of 24J, probably no deduction. If we fall inside of 24J, deduction by virtue of the operation of Section 24J. That's why this was an issue in the tax court. Because it sounds like a simple issue to worry about, is a raising fee in similar finance charge or not, but that's the context behind it. And the court said, okay, fine, when you look at the definition of the word interest, which is where there's this reference to similar finance charges, it says interest is defined as interest or similar finance charges in respect of a financial arrangement, right? So the court says, okay, fine, we have to interpret what similar finance charges mean, and we have to do that in context of Section 24J as a whole and for purpose, right? And it says, well, when you look at the definition, it says interest or similar finance charges, right? So clearly, by use of the word or, the legislator is distinguishing between interest and something else. It cannot be interest and interest. It is clearly interest or something else, right? And then he says, okay, well, clearly it's not interest. So similar finance charges is not interest. Otherwise, they would have just stopped at interest, right? And so also the court says, well, it says similar finance charges, not the same, not identical. So clearly the definition envisages something other than interest, but of a similar nature, right? And the court ultimately says, well, finance charges is similar to interest. It's not interest. By no stretch of the imagination is it interest, but it doesn't have to be. It doesn't have to be identical. It simply has to be similar, right? And the court says, well, a raising fee, first of all, is without a doubt a finance charge. Is it similar to interest? Well, yes, because it doesn't have to be identical. But the question is, if we say similar, because the court goes on to say normally the word similar and the extent of similar is determined by some form of adjective that precedes the word similar. Very similar, almost similar, exactly similar, but we don't have that in the context, right? We only have the word similar. So we don't have that adjective to say, well, then how do we determine similar? And the court said, well, you have to determine similar with reference to what is similar, in what relevant respects must it be similar, right? And he uses this example, which I found quite interesting. The court uses this example to say, if you've got a housing scheme, right, and the housing scheme, for example, says all houses must be painted blue, right? Or it must have a particular color. It says, well, fine, if we now have to determine if the one house is similar to the other, they are both houses, but the one is blue and the other one is pink. So the other one is dissimilar to the other one because there's a parameter, what is relevant to determine similarity. And he says, well, the only relevant thing we have here, absent an adjective that describes the extent of similarity, is the word interest, because clearly it has to be similar to interest. So that's the relevant aspect. And he says, okay, fine. Interest is interest is, by common law, is the money you pay as compensation for borrowing or using someone else's money, right? And he says, well, this is a finance charge. We know that because a raising fee is a finance charge, and it's similar. It's not identical. I grant you, it's not identical. but it is similar. And the court ultimately concludes finance raising fees are similar. Almost exactly 12 months later, the interpretation note is dropped by SARS, interpretation note 142, right? Almost exactly 12 months later. I think it's 1 day out, right? And the note purports to be a note on the meaning of the word similar finance charges, but they don't actually tell you what it is. But what they do tell you is they tell you that raising fees are not similar finance charges, right? Now, before we go into SARS's view on why it's not similar, because they do give a detailed view as to why they think it's not similar finance charges, I have the question, and myself and Vickers discussed this, is why? Why do they issue this thing? I mean, tax court judgments don't set a precedent, so it's not as if the judgment of the tax court opened the floodgates. Now everybody's going to go claim raising fees, at least in principle, right? But then SARS's note equally does not create a precedent or set a precedent and is not law, right? So what have they done by issuing this note? They've created confusion and they've created much uncertainty, right? Because now what must the taxpayer now do? There's a court ruling which is only of persuasive value. It's not precedent setting. And then that says that raising fees are similar finance charges, so you should have a basis for deducting it. You might turn out to be wrong because it might on appeal, SARS might win, but then you have a valid basis for claiming that, right? But now SARS issues this note that says, no, you can't. So now, what is a taxpayer supposed to do? And in my view, the only purpose of this is to try and, I wouldn't say scare, but to stop the floodgates from opening, even though they shouldn't be opening, right? At least to put some form of barrier in, because now arguably if you just go and you rely on this judgment and you claim you're raising fees, SARS might say, but hang on, yes, that's what the court said, but we clearly told you that we disagree. So just going ahead and claiming it might give SARS the chance to impose an understatement penalty, right? So my view is the timing of this is to try and nevertheless go back and reverse, one. Two, perhaps potentially also to make amendments to the legislation retrospectively, right? But also to stop taxpayers from claiming this. But that doesn't mean you can't. All it means, in my view, is that you're going to have to, if you want to claim a raising fee, right, as a 24J deduction, which is not, remember, it's on a yield to maturity basis, right? But if you want to go ahead and claim a raising fee, given these two contradicting views, you'd probably need a third view, probably from a tax professional to say, I think SARS is wrong, or I think the court is right, or whatever the case might be, because that gives you then a reasonable basis on which to pursue your claim if you want to, right? Failing that, of course, you can take the more prudent approach, right? So let me explain SARS's view as to why they think the tax court is wrong, and they say that, and which they're entitled to do because the tax court judgments don't set a precedent, and it won't be the first time where SARS disagrees with the judgment of a tax court and say so publicly. I mean, it's what it is. So what SARS, the view they take is they say, look, interest ultimately is the compensation paid by a lender to the borrower for the use of borrowed funds. It says how that compensation is determined, whether it's the fixed rate of interest, a variable rate of interest, or some other basis, doesn't matter. The question is, what is it that you are paying for? Are you paying for the use of someone else's money? Then that would be interest. They say a raising fee is a fee paid by the lender for making available a loan, which is distinct from the amount paid for the use of the money, right? They say the raising fee is something that you pay to get the money. And in fact, they go so far as to say, I think, is that let's say you start this process of borrowing money from a bank, right? But you don't follow through, you're still going to pay the raising fee. So therefore, clearly the raising fee is not for the use of money, of the lender's money. It is for the acquisition, for the making available. It's for the admin cost for the bank to cover their cost of doing this, processing this application. That's what they're saying. And they say that raising fees are not of the same character as interest, right? And then they go on to say that raising fees is therefore not similar to interest, right? They go on and they say that to be similar, right, or for finance charges are supposed to be similar to interest, they agree that it doesn't have to be identical, right? So they agree with the court where it says, well, it doesn't have to be identical, but they say that interest is just raising fees are just too dissimilar. It's not similar enough, right? And they go on to say, and this is where they start justifying their view, is they say to allow effectively raising fees to fall within the ambit of 24J, that would effectively amount to the scope of 24J being extended to regulate the inclusion in income and the deduction from income of things that are not interest, right? And 24J was always, it's a convincing argument. I could see your reactions. Everybody goes, that's a valid argument. I'm not saying they're wrong, and it is a valid argument. It sounds very valid, right? And they go on to say, is when you look at the history behind Section 24J and the amendments, which the court also looked at when it interpreted similar finance charges, they say that it was never the intention for 24J to regulate something that is not interest, which clearly raising fees are not, according to them. And they use this example to say, well, and we discussed this earlier, is if you look at the 8th schedule that talks about base cost, paragraph 20 in particular, it says you can add interest and raising fees and other finance charges to the base cost of certain assets, right? Of certain assets. And they say that if the legislator had envisaged for raising fees to be included in the definition of 24J, then they would not in the 8th schedule have said interest is defined in 24J and raising fees, because just reference to 24J, interest is defined, 24J would have been sufficient, right? And so that's their argument, right? Now, their argument, as convincing as it seems and as it is, I'll grant them that, I'll give you my take on it, is I think that SARS is conflating, even though they acknowledge that similar doesn't mean identical, I think they are nevertheless forcing or conflating similar with the same. They want it to be too close. You cannot get away from the fact that the legislator said interest or similar finance charges. I know you want to say that, why then in the 8th schedule do they refer to that? I don't know. Why do they refer to raising fees apart from interest as defined in 24J? I don't know, but when I look at the plain wording in front of me, it says interest or similar finance charges. And if you were to say that, okay, and to just back up why I'm saying they're conflating the two, is they keep on saying that interest must be, to be similar to interest, it must be money or a compensation paid for the use of money. But that's interest. So they say to be similar to interest, then it must be interest. Why do we have an or? And I must be honest, I mean, when I read, I can see merit in both. I mean, when I was discussing with you guys now, you all go, well, that kind of makes sense too. But then you can't get away from the word or and the fact that the legislator distinguished. And I think what's happening here is when in the tax court, the court says, well, it goes through and it reads all the judgments that's been handed down before on what is how you interpret legislation, and there's lots of things about how you interpret legislation, lots of rules. But one of the things that the tax court says is when you interpret legislation, you must be careful, right? That your interpretive exercise is not aimed at rationalizing a predetermined result, right? You must enter the interpretation process open-minded and not with some preconceived end result in mind, because then what you do is you are not interpreting, you are rationalizing the end result. And I think that oftentimes, I suspect, and I'm only speculating, that SARS often makes themselves guilty of this rule. Because remember, SARS is very close to policy, right? It's the same if I think about that case where there was a contract miner. You guys might not remember it, but years ago, there was a case in the tax court where a contract miner wanted to claim deductions in the mining tax scheme, right? And the court, SARS vehemently argued that was never the intention and that was not that, etc. And the court said, I hear you, but that's not how the words read, right? Unfortunately, that might have been what was intended, but that is not what it says here. If you wanted to have that result, go change the legislation. And I think here we have something similar, I think, where because SARS is very close to policy. And in their minds, when the legislation is formulated, of which they form an integral part, as does industry, they have in mind that 24J is limited to interest, right? And so when they then go through and they draft the legislation, well, they don't. There's draft legislation, but they're very close to the policy decisions. And the policy was never to allow raising fees in their mind, but it was not written down like that. And so I think that oftentimes SARS find themselves making themselves guilty of rationalizing a preconceived result, because when they were part of the policy decision and part of the legislating process, in their minds, that was what the purpose was. But when you read it coldly, the purpose doesn't quite come to where you want it to be, right? And that's the way I read SARS's note. Practical implications, what does this mean for taxpayers if we've got two opposing views, right? My issue is if you blindly follow SARS, you risk losing out a deduction, right? But that will be the most prudent route to go, to say, well, okay, I know that SARS doesn't like this, so let's just not claim it at all. The trouble with that is who knows when this judgment is going to be handed, because SARS has taken this on appeal. Who knows when we're going to get this judgment handed down on appeal, right? And who knows who's going to, after that, take it on review in the Constitutional Court if that happens, because it happened in Coronation recently and it happened in Thistle. So we could be sitting with 3-4 years of uncertainty, right? If you don't claim it, you run issues, if SARS then later loses, you run into issues with prescription, you run into issues with time periods to try and correct those assessments. So not claiming it, yes, it's the more prudent approach, I suppose, if you want to avoid penalties altogether, right, and interest. But then you run the risk of potentially losing out that deduction, depending on when finality is given on this. If you just claim it blindly, SARS is going to say to you, you don't have reasonable grounds because we've told you before that we don't think it's deductible. And I'm going to use this, what happened in Thistle, right? In the Constitutional Court, SARS argued that they said, because remember the issue in Thistle was whether or not the flow-through principle applies, we've got multiple tier trust structures. And there was a clear view from SARS is that that is not allowed. But the taxpayer went and got an opinion and said it is allowed. And in that opinion, if I recall correctly, the guy said, remember, SARS has got a different view. Right? I'm expressing a view, I think, presumably as the opinion read, I think it's allowable. But bear in mind, I'm warning you, SARS has a different view. And then SARS argued in the Constitutional Court that the taxpayer, being warned that SARS has a different view, ought to have taken SARS's position and disregarded the professional's position, and therefore the taxpayer must still be guilty and suffer an understatement penalty. Almost as if to say, our interpretation is the only valid interpretation out there, and if you deviate from that, we're allowed to penalize you. And I'm not saying that's what happened here, I'm just interpreting it coldly and making assumptions. But when I look at this seems to be where they're heading with this, right? To say that we have a different view, if you just go counter to our view, you don't have reasonable grounds. I'm not saying they'll succeed with that. And I think practically what this means is if you are going to go and claim raising fees when we have these two opposing views, neither of them precedent setting, both of them, I suppose, persuasive, what do? You either take the prudent approach, which you run the risk of admin in future and potentially losing it because of prescription and time periods and those sorts of things. Claiming it, SARS wins on appeal, right? And then you're exposed to penalties and interest. The only thing that you can do, in my view, given what SARS has done here by issuing this interpretation note, in my view, is you'd have to get an opinion from a registered tax professional, if you're going to claim it as a raising fee, to justify why the court is correct in your view as a tax professional and why SARS is wrong. Or if you agree with SARS, why SARS is right and the court is wrong. I think that is the practical implication for taxpayers. What must I now do with this, right? Because again, the timing of it is odd. It's created confusion. I understand the sense that they try and block or stop the floodgates from opening, if you will, but it is a little bit problematic. Only way I think you can deal with it is to you need to split the tie, right? If you're going to take a position, there's a tie, you need to get someone to break the tie for you. And obviously that needs to be a qualified professional, etc., to protect you against penalties. Because in Thistle, they raised exactly this point. The guy even had an opinion, right, where they tried to say not the SCA, in fact, the Constitutional Court, I think, ultimately said that that can't be right. If SARS was too right to say that if taxpayers know that SARS is an opposing view and don't follow it, then they must be penalized. The court said, well, that supposes that only SARS's view can be right. And of course, that can't be right. So I think that is that's all of it on interpretation 142 that I wanted to discuss. Like I said, I mean, the note purports to be a note on the meaning of similar finance charges, but they don't actually tell you what it is. What they do say is raising fees is not, right? So it seems to me like an interpretation note to say that raising fees are not similar finance charges. Right, does that make sense?